Imagine you're like an insurance underwriter, right? And your phone rings.
Okay.
The broker on the other end says they need a multi-million-dollar liability policy for a brand new axe throwing bar.
Oh, wow.
Yeah, and before you can even answer that one, the next call comes in. It's a cannabis grow farm in a state with these highly complex regulations.
Naturally.
And then the third call, a massive, completely chaotic high school prom. Now, if you work at a standard household name insurance company, you hang up the phone immediately.
Yeah, you are running for the hills.
Exactly. But there's this one company that actually says yes to those calls. Like, they deliberately seek out the most bizarre, untouchable risks in the market. And they have quietly been a 24-bagger since their IPO in 2016.
Well, it is the absolute definition of hiding in plain sight. I mean, we are looking at a corporate landscape that seems incredibly mundane on the surface.
Right, sounds like a total snoozer.
But it operates with this completely ruthless, highly lucrative underlying math.
Welcome to the deep dive. Our mission today is to step directly into the shoes of an equity analyst. We are building an investment thesis on Kinsale Capital Group.
Ticker symbol KNSL.
Yep. We've got financial deep dives, video analyses, and interviews with their CEO. We want to understand their financial mechanics, their strategy, and, how they produce these massive returns.
Because if you're building a portfolio, or if you just want to see how a seemingly boring financial sector generates hyper-growth, you really have to understand the specific sandbox that Kinsale plays in.
Right. And to understand why Kinsale is such an intriguing investment for you, the listener, we have to talk about that sandbox.
Yeah, you really can't evaluate the company without evaluating its market structure first.
So, okay, let's unpack this. Because the total U.S. property and casualty market,
What the industry calls PNC.
right, PNC, it's massive. Like about $1 trillion changes hands. But Kinsale ignores almost all of it.
Yeah, they focus entirely on just an 11% slice of that pie. It's worth about $115 billion, and it's known as the excess and surplus market, or ENS.
It's like standard insurance is a fixed fast food menu. You can get a burger, you can get fries, but if you walk in and ask for like a medium rare venison steak, they just stare at you.
Yeah, they point to the door. Standard players like State Farm, Allstate, Travelers, they want preferred, low-risk, highly predictable business.
But the ENS market is like a custom tailor for the island of misfit toys businesses. You tell them what you need, and they build a bespoke policy just for you.
Exactly. And look at how this customization works in practice. There's this anecdote from the sources about a talented, highly skilled dentist who, unfortunately, had a history of sexual misconduct allegations from his patients.
I mean, obviously, standard insurers wouldn't touch him.
No, not at all. The liability risk of an intentional, malicious act occurring right there on the premises is a massive red flag. Standard policies are basically boilerplate. They take the whole risk or none of it.
Right. So they pass, but Kinsale stepped in.
Yeah, because they operate in the ENS market, they use something called the freedom of rate and form.
Which basically means they can write whatever they want, right?
Exactly. They wrote a custom, surgically precise policy. They insured his dental malpractice because objectively, he was a competent dentist performing standard dental procedures. But they explicitly wrote in a clause excluding any coverage for intentional or personal misconduct.
Oh, wow. So they just carve out the bad part.
Yeah. And that surgical precision is only legally possible because ENS insurers aren't subject to the strict state-level rate filings that standard insurers are.
Right, because standard insurers have to go to the state regulator for every little change.
Exactly. And that regulator acts as a watchdog for consumers, keeping prices artificially stable and policies standardized. But in the ENS free market, Kinsale just bypasses that red tape.
So they can charge exactly what the market will bear. They customize the exclusions, ring-fence the danger, and turn a perceived high risk into a very calculated high reward.
Yeah, it's brilliant.
But wait, hold on. If they are building custom-tailored policies for every single misfit toy out there, how does the math actually work?
What do you mean?
Well, Kinsale specifically targets small accounts, right? Their average policy premium is just $15,000.
Yeah, that's right.
If you have to bring in lawyers and specialized underwriters to surgically remove risks for an axe-throwing venue, the administrative overhead and the paperwork alone eat up that $15,000. How are they not bleeding money just to get the policy out the door?
See, that skepticism is exactly what almost every legacy competitor in the industry thinks. Most of the insurance world fundamentally believes you cannot afford to underwrite policies that small.
Because the math just doesn't work with a traditional overhead structure.
Exactly. And because of that widespread belief, Kinsale's competitors almost universally outsource their small account underwriting to third parties. They use what are called managing general agents, or MGAs.
So the competitors just throw their hands up, say this is too small for us to deal with, and hand the pen over to a middleman.
They hand over the pen. And what's fascinating here is that in doing so, they introduce a massive principal-agent problem.
Right, the classic misalignment.
Yeah, MGAs are essentially specialty brokers acting as sales organizations. Their primary compensation comes from commissions based on premium volume.
So they just want to sell as much as possible.
They are completely incentivized to close deals, write policies, and pump up top-line revenue. But the MGA takes zero downside risk if the policy they just wrote results in a $10 million claim.
Wait, really? Zero risk?
Zero. The insurance company pays the massive claim, while the MGA keeps their nice commission.
It would be like me paying you a commission to pick stocks from my portfolio, but you don't lose a single dime if the stock's good as zero. You're just going to buy the most volatile, crazy momentum stocks to pump up the trading volume.
Because you only get paid on the transaction, not the outcome.
Exactly. And Kinsale refuses to play that game.
Completely. They keep 100% of their underwriting in-house. Their underwriters are paid bonuses based first on underwriting profit, meaning the policy actually made money, and only second on volume.
And that completely changes behavior, like the story with the firearms manufacturer.
Yeah, consider how this plays out on the ground. A firearms manufacturer was up for renewal. Kinsale evaluated the risk, did all the math, and quoted the renewal premium at $170,000.
Which is a huge account for a company whose average policy is only $15,000.
A massive account. But an MGA swooped in, representing a competing insurance carrier, and took the business away.
By undercutting them.
Severely. They quoted it at $57,000, exactly one-third of Kinsale's calculated price.
How does an underwriter even justify a price cut that deep? The underlying risk of a firearms manufacturer didn't magically change overnight?
It didn't. The MGA achieved that low price by deliberately misclassifying the business. On the paperwork, they underwrote the client as a sporting goods distributor instead of a firearms manufacturer.
Oh my gosh, because sporting goods distributors have much lower liability profiles, like, baseball bats and basketballs.
Exactly. And Kinsale's underwriters looked at that, recognized they were dealing with bad business and faulty data, and simply walked away.
They just walked away from a huge premium.
Because if you don't even know what you are insuring, you can't possibly manage profitability.
Kinsale's ultimate moat really is that discipline. They refuse to rely on the honesty of a middleman. But bringing all that underwriting in-house brings us back to my earlier point.
The administrative burden.
Right. It only works if your operations are ruthlessly efficient. Otherwise, you just drown in the paperwork of processing thousands of tiny policies. This is where Kinsale's technology acts as a massive structural advantage.
And you have to contrast that with the broader insurance industry, which is notorious for being incredibly slow-moving. It is burdened by decades of legacy systems.
Yeah, when you look at the legacy giants, companies like AIG or Chubb, they grew through endless acquisitions over 50 or 60 years.
Imagine buying a regional insurer in 1998, another in 2005, and another in 2012. You don't just magically merge their databases.
No, you end up bolting 40 different mainframe computers together that literally cannot talk to each other.
You literally have claims adjusters copy-pasting an address from a 1990s DOS-based black and green screen into a modern web browser just to process a basic claim.
There's that incredible story about the claims examiner who left Kinsale. She went to work for a competitor in the exact same city.
Okay, and a few months later, she ended up having lunch with her old Kinsale coworkers, complaining bitterly.
Because at her new job, she had to toggle between 6 to 8 different fragmented legacy systems all day long just to do her basic tasks. But at Kinsale, she had a single, seamlessly integrated screen.
That's because when CEO Michael Kehoe founded Kinsale in 2009, he started with a blank sheet of paper. They spent 7 years building a proprietary enterprise system from scratch before they even tried to scale up.
7 years?
Yeah. Today, over 20% of their roughly 700 employees work in IT. They aren't just, like, fixing printers. They are software developers constantly automating the underwriting workflow.
So what does this all mean? Like, having a nice software interface is great, but it has to translate into hard financial numbers to build a real thesis.
Well, in the insurance sector, the ultimate metric you need to memorize is the combined ratio.
Right. Claims plus expenses divided by premiums.
Exactly. Anything under 100% means the company is actually making a profit on the insurance policies themselves before they even invest a single dime of the cash they collect.
Okay, so what are the benchmarks?
The broader industry average for the combined ratio hovers around 91%. A top-tier competitor in the E&S space, a company like Markel, sits at about 95%.
Okay, so a great competitor is operating at a 95% combined ratio, meaning for every $100 they take in, they keep $5 in profit. Where does Kinsale sit?
Kinsale sits at an astonishing 75.9%.
Wait, really? 75.9, that is absurd.
It's incredible.
That means for every $100 they take in, they're keeping roughly $24 in pure underwriting profit. They are playing a completely different sport than the rest of the industry.
And that massive gap isn't just about picking better risks. It is heavily driven by their expense ratio. Because of their automation and lacking MGA commissions, Kinsale's expense ratio is a mere 21%.
Wow, and the competitors?
They were paying 15% commissions to MGAs and huge administrative teams to drag along legacy tech. They languish in the mid-30s to 40s.
And that technological speed is an actual weapon in the marketplace, right? Because their system is so automated, they can often turn around a quote within 24 hours.
Which is huge. Put yourself in the shoes of a broker. You have a commercial contractor who just won a major project, but they can't step foot on the job site until they provide proof of liability insurance to the developer.
Speed is literally money.
Exactly. If Kinsale can get you a bindable quote in a day, while a legacy giant takes 3 weeks to pass the file through 4 departments, you're going to send that business to Kinsale every single time.
It creates this beautiful operational flywheel. Better tech means lower costs and faster quotes. Faster quotes make brokers happy, which drives more volume to Kinsale. More volume equals more data, making underwriting more accurate, keeping that combined ratio at 75.9%.
It's a very tight feedback loop.
But we've only talked about the mechanics of the actual policies. If you study Warren Buffett's philosophy on insurance, the real magic of an insurance compounder isn't just the underwriting profit.
No, it's what the company does with the cash before they actually have to pay it out to cover a claim.
Right. We are talking about the float. Kinsale holds over $3 billion in reserves.
When you buy a commercial policy, you pay your premium upfront today. But if you have a claim, say someone slips and falls at your axe-throwing venue, it might take months or even years of litigation before Kinsale actually writes the check.
And in the meantime, they are holding on to that $3 billion. It's essentially leverage with a negative interest rate. If your combined ratio is under 100, people are literally paying you to hold their money.
So what do they do with it? They invest it.
Yeah.
Highly conservatively. They aren't taking wild bets in equities or acting like a hedge fund.
Mostly fixed income instruments, right? Like
Yeah.
highly rated corporate bonds and treasuries.
Yeah. But because the pool of money is so massive, even a conservative yield generates extraordinary income. In 2025 alone, they generated $192 million in net investment income.
And that flows straight to the bottom line, totally independent of their underwriting.
Completely independent. And the capital allocation strategy here is driven by a management team deeply aligned with shareholders. Founder and CEO Michael Kehoe still runs the show,
And he has serious skin in the game. He owns about 4% of the company.
which translates to roughly $350 million. You always want to look at how executives are incentivized. He isn't trying to pump the stock in the short term or grow volume recklessly.
Right, his compensation is tied directly to return on equity and maintaining that pristine combined ratio.
The results are staggering. Since 2018, Kinsale's book value has compounded at 33% annually.
Which is wild. Warren Buffett's Berkshire Hathaway compounded at about 10% over that same period.
Kinsale's return on equity consistently sits around 26 to 7%. They are just a capital allocating machine.
Okay, here's where it gets really interesting. If we are building a true equity analyst thesis, we have to stress test the downside. The historical performance is great, but what actually breaks this model?
Yeah, we have to look at the bear case because the stock took a massive hit recently, roughly halving from its 2024 peak down to around $300 a share.
Right. If the company's this pristine, why did the market punish them so severely?
It comes down to the cyclical nature of the global insurance market. The industry constantly moves between hard markets and soft markets.
Okay, explain the difference.
For the last few years, we've been in a hard market. Available capital was scarce, rates were high, and the insurers held all the pricing power. It was an amazing time to be an E&S player.
But capital abhors a vacuum. When an industry is making massive profits, new money just floods in to grab a piece.
Exactly. And now we're shifting into a soft market. Reinsurance capital has flooded back in. Competitors are flush with cash and getting aggressive, slashing prices just to win market share.
And because Kinsale is fundamentally disciplined, they refuse to chase bad prices down to the bottom. like with the firearms manufacturer. If the price doesn't justify the risk, they just walk away.
And as a result of holding that line, their commercial property premiums, which is their biggest division, recently dropped by 18%.
So they protect their margins, but their top-line revenue growth is slowing down significantly.
And Wall Street is notoriously unforgiving when a hyper-growth story begins to decelerate. That shift is the primary pressure on the stock right now.
There are other structural risks too, right? Like broker concentration.
Huge risk. Despite processing hundreds of thousands of quotes, about half of Kinsale's actual premium volume flows through just 3 massive wholesale brokers.
So if a relationship with one of those big 3 sours or a competitor offers a massive incentive to route business elsewhere, that's a severe hit to Kinsale's volume.
Absolutely. Then there is the unavoidable reality of catastrophe risk. They write a lot of business in highly exposed states like Florida and California.
Places with hurricanes and wildfires.
Right. When the Palisades fire swept through California in early 2025, the influx of claims pushed Kinsale's combined ratio up to 82% for that quarter.
Still highly profitable compared to the industry, but it shows how a single severe weather event can suddenly eat into those margins.
But those are just operational risks. If we step back, there's an existential question about their ultimate moat. Kinsale won the 2010s by building better software and using years of structured data to price risks.
But now we're in the era of artificial intelligence.
Exactly. If AI makes data analysis incredibly cheap and fundamentally easy, the playing field suddenly changes.
Because the legacy giants like AIG or Chubb, even with their terrible fragmented software, they possess decades more historical claims data than Kinsale.
It's sitting deep in their vaults. Unstructured, messy data used to be a liability.
But if they deploy AI models to suddenly ingest, clean, and analyze 50 years of unstructured data, they could close Kinsale's technological gap almost overnight.
Kinsale won by building a better calculator from scratch. But if AI gives every lumbering giant a supercomputer, Kinsale's advantage erodes.
Which brings us to the ultimate question of valuation. With the stock trading around $300, it carries a price-to-earnings ratio of around 13.5 to 18. But more importantly, a price-to-book ratio of 4.5.
And in insurance, price-to-book is the vital metric. An insurer's book is literally their balance sheet, their cash and investments.
So a price-to-book of 1 means you're buying the company for exactly the cash it holds. Most insurers trade at maybe 1 or 2. Paying 4.5 times the book value means you are paying a massive premium for future earning power.
It sounds insanely expensive.
Yeah.
But the argument is that Kinsale isn't a normal insurer. If they keep compounding book value at 30% and generate a 26% return on equity, a 4.5 multiple is completely justified.
Right, but some analysts argue that the stock is attractively priced right now only if you accept the new reality. The era of 30% top-line hypergrowth is likely over because of the softening market.
It requires a fundamental adjustment in expectations for the investor. You aren't buying an explosive startup anymore. You are buying a mature compounder navigating a competitive cycle.
So, if you are putting together the final pieces of this investment thesis for yourself, Kinsale is a best-in-class, founder-led E&S insurer. They possess a massive cost advantage thanks to their in-house tech, and they enforce unmatched discipline by eliminating the MGA middleman.
However, they are currently sailing straight into the headwinds of a softening market, forcing them to sacrifice growth to maintain margins.
It is a true test of executive discipline. Will Michael Kehoe and his team hold the line when the rest of the market is throwing caution to the wind? History suggests they will, but you need to be prepared for lumpier, slower growth in the near term.
It's the ultimate test of a compounder.
I want to leave you with a final thought to mull over regarding that AI risk we explored. For the last 10 years, Kinsale proved that a nimble, tech-forward upstart could run absolute circles around the legacy giants.
Because they had clean data and a single IT system.
Right. But as we look to the 2020s and beyond, if AI really is the ultimate unlock for messy information, could those sane sleeping giants use AI to turn their decades of fragmented, unusable files into the ultimate competitive weapon?
It is arguably the defining technological question for the next decade of risk management.
It's a fascinating pivot point, not just for Kinsale, but for the entire financial sector. Thank you for joining us on this deep dive. Hopefully the next time someone brings up the insurance industry, you won't just picture a dense packet of paper. You'll picture the misfit toys, the axe-throwing venues, and the brilliant machinery required to maintain a 75.9% combined ratio. See you next time.